Before we dive into today's podcast, I just wanted to say a big thank you to our new sponsors of the next few episodes, and that's SumSub. If you haven't heard of SumSub, they're a global AML, KYC, and KYB solutions business operating not only here in South Africa but across the continent. Great business, great group of people. Got to know them really well over the last few months, and a big thank you to the entire team for sponsoring Talking Success and the next few episodes. So if you are looking for any compliance solutions around AML, KYC, KYB, give the guys at SumSub a shout. You'll be in safe hands. So thank you very much and enjoy the show.
Hey everyone, welcome back to Talking Success. We've gone through a massive journey this last year. We've spoken about crypto, we've spoken about stablecoins, we've spoken about compliance and money laundering and digital banking and digital transformation. We've covered such a plethora of topics. And then I received an email out of the blue a couple of weeks ago by Yaacov, who I'm going to introduce to you in a minute, by one of his team saying, look, have you heard of this thing called embedded lending? No, I've heard of embedded finance, but not necessarily embedded lending. And they said, listen, you may want to have a chat with Yaacov. So here we are. So guys, I know nothing about embedded lending. I'm here to learn selfishly, and I'm hoping I'm going to get a really good overview in terms of what this whole concept around embedded lending is. And clearly, there's no one better to talk us through this than Yaacov Martin, who joins us from Israel today. Spends half his time in New York, half his time in Israel, and other sort of places across the planet. So Yaacov, amazing to have you on. Thank you so much for joining. Welcome. I'd love to first get an intro from you in terms of your background and kind of what you're doing now. And then I want to dive as deep as we can into the world of embedded lending.
Sure. So first of all, Darren, thank you for having me. It's a real pleasure speaking to you and to your followers. So happy to give just a little bit of background of myself. I've actually been doing this, running Jifiti for quite a while now. It's probably been about 12 years. And as many other tech companies do, we too have undergone an evolutionary process. So we learned things as we went along and developed accordingly. The markets have developed as well, and that obviously keeps us on our toes. Hopefully, sometimes we predict the direction, and sometimes you have to roll with the punches, but that's all part of the fun and games. And what we, in a moment, we'll dive obviously a little bit deeper, but we really work across many markets. So we are global in that sense with both financial institutions and then merchants and other service providers on the other hand, in order to make this embedded lending, or embedded is maybe a branch of embedded finance, but embedded lending available. And we'll speak in a moment just about what that means.
Thank you. Can we start with that? So high level wise, embedded lending. Well, actually, maybe we take that back a step. Let's talk about embedded finance. I know a lot of people listening to this podcast will have heard the term embedded finance. Do you want to just unravel that a little bit, and then we can dive into kind of the subset, which is embedded lending?
Sure. So let's speak really, first of all, about embedded finance, as it really does, like you said, define the broader industry. So when we speak about finance being embedded, what we're actually saying is that often finance dictates many different behaviors and many different transactions that a consumer or a small business is contemplating. So for example, whenever you go about your day-to-day life, both as an individual and as a business owner, you have many decisions you have to make. You have many different goals that you're looking to achieve, and many of them involve, by definition, finance. And when I say finance, that just means that there's a transactional component. Sometimes that transaction is a relatively small one that you do without thinking twice. You pull out your credit card or you do it in any other way. And there are others, usually more meaningful transactions, where you need some planning. You need the tools. You need to think about your cash flow. You need to think about how you're going to finance that. Now, once upon a time, when you were about to go about making a change that required finance, you may have made an appointment with your banker and gone to speak to him or her and see what your options were. The idea of embedding finance is bringing that discussion, so to speak, often digitally, to the point where that transaction can be made. In other words, instead of bringing the customer to the bank or to the financial institution, we're bringing the bank or financial institution to the customer by embedding that access into wherever that discussion or that decision is taking place. That's a very, very general conceptual definition for what embedded finance is.
Can you give a couple of examples of that people may be used to? Whether it's something like Uber or whether it's another sort of a daily app that someone may use on their phone where they're experiencing embedded finance, but perhaps don't know that it's actually called embedded finance.
Sure. So actually, that's a great segue because I'm going to do two things. I'm going to try to answer your question with a few examples, and that'll take us directly into this branch of embedded lending that I spoke about. Many, I think, of your audience members are probably familiar with what has become buy now, pay later. Buy now, pay later is a way of splitting your payment at checkout. So if you were shopping online, even in store, although we'll speak about in store a little bit separately, and you've put certain things in your basket, you arrive at the checkout and you say, wow, I've actually accumulated quite a few pairs of sneakers or shirts or whatever it may be that you were shopping for. And that's quite steep for me to just pay in one-time payments. But once upon a time, that was up to you. I mean, you essentially online had the option of paying with a credit card or PayPal maybe, but you didn't really have options beyond that. Embedded finance, and specifically in this case, BNPL, gave you the option of splitting that payment. Now, once again, instead of pausing that experience, that online shopping experience, figuring out some kind of payment plan, maybe with your bank or with your credit card issuer, here it was built into the checkout. Yes, no problem. You would like to split your payment. There are various providers across the globe that really grew their business on the notion of allowing consumers usually to split their basket into 3 or 4 payments. The reason that I am specifically giving the example of splitting into 3 or 4 payments is because, at least in our lingo, buy now, pay later usually means not a full-fledged underwritten loan, but rather a split pay. Until not long ago, this was an unregulated, it was really considered a payment method by the regulators in most Western countries. And this was embedded into the checkout experience. So instead of later following up with your bank and figuring out how you're going to pay off your credit card bill, you ahead of time had this embedded offering of splitting your payment into 3 or 4.
Okay, so that makes complete sense from buy now, pay later. I think a lot of people will be used to. Again, we're talking perhaps to the majority of our viewers and listeners who are across the African continent. If you're looking at Takealot here, which is a kind of equivalent to Amazon, when you go to checkout, you have various different options for buy now, pay later, or entering your credit card, or using an EFT or what have you. What Yaacov, I think, is saying here that when you land on the BNPL option, that is embedded within the Takealot platform. You don't then need to go off of Takealot to then go to a separate third party to apply or to go through that process and then to check out. You do that all within, in this example, the Takealot app. So that's definitely one area of BNPL. Are there other areas? Would you class payments as being embedded finance as well, or is that a separate kind of category?
So in many ways, payments is an embedded finance, although we do like sometimes in FinTech to attribute different terms. One is payments, one is finance, where payments is really just the activity of transferring funds from one place to another, while finance usually includes some sort of trade or underwriting activity. So let me give you, actually, if you mention this, I'll give you another example that in my mind is definitely embedded finance. It's not embedded lending, and that is Forex. So again, up until recently, if you were transacting in a different currency to the currency that you generally have your credit cards originating from, then you had a Forex issue. You were paying in pounds with a credit card that was connected or linked to a dollar account, for example. Now, how did that take place? So once upon a time, it was entirely difficult, but as credit cards became more and more global, then there was some kind of conversion that went on between yourself as an end user and your credit card, and you paid a premium on that. Now, of course, that's something that became just general practice. But what about when you're really speaking about larger types of transactions, where that 1 or 2 or sometimes even 3% on Forex begins to take a toll on the total sum of the purchase? Well, in that case, you may have in the past gone to your bank and said, listen, I'd like to buy pounds and put them in my account and link my card to the pounds as well. So at least when I'm transacting in pounds, I won't have to go through this expensive on the fly conversion. And again, that meant that you either had to have this predetermined or pause your activity and make arrangements with your bank. The idea of embedding various Forex services within a site to allow you to leverage a better rate from another provider, meaning essentially what's happening is you're paying your provider in one currency, this third-party provider, and the provider completes the transaction in another currency, but gives you a better rate and you enjoy the arbitrage, then is another mode of embedded finance. Again, this speaks a little bit less to consumers, but much, much more to B2B, where they may be trading on higher volumes and higher rate transactions. The idea of not having to pause the activity and having optionality embedded into the platform that you're currently on doing whatever you're doing is really bringing to fruition this idea of embedded finance.
And essentially, Yaacov, what we're talking about here, certainly from the consumer perspective, or the consumer model is, making this as easy and as less cumbersome as possible, right? So enhancing the journey. But what we're not doing is adding, or what embedded finance is doing, or embedded lending is doing, is not creating more complications and more steps. Actually, what it's doing is refining those and making it a lot more simple for people to then go, actually, I have got an option of using my credit card, going back to the merchant side. I have got an option to use my credit card. I have got an option to, instantly pay using, an EFT, or I can use a buy now, pay later product or a lay-by product or whatever it may be. I don't have to then navigate externally, then come back and finish my transaction. I think from a merchant perspective as well, they don't want that, because they want to ensure that, that the basket remains there and is procured as quickly as possible. They don't want to lose the customer to an external site, because maybe you're like me, but as soon as I go from one page to another page, that's it, I'm off. I'm distracted, and then I'm on something else and I'm going somewhere else. So I can see the benefit for merchant, customer, and for consumer. What about for the financial services provider that's providing those services? Again, I want to understand a bit more about what you guys do and the products that you offer. Maybe we'll start there, because I wouldn't want to compromise you by asking you questions that maybe about your competitors. So you tell me a little bit about what you guys do and where you fit into the...
Yeah, sure. So I think that's a very good way to structure it, because I think it'll actually highlight some of the comments that you made about the conversion, about the abandonment. We don't want anyone abandoning the experience or the journey that they're on, the website that they're on, or even we're going to speak about brick and mortar as well. We don't want to pause that activity because you're losing the momentum. That's one aspect. The other aspect is that you're giving the consumer, in this case, optionality. But there is going to be a whole category that we'll get to, where in our case, embedded lending opens the door to transactions that otherwise would probably not have been possible within that one swoop of activities. So let's go to what we do. And then we'll also try to answer your last question, which was, what is either the benefit or how does the financial institution or bank play part in this game? So what we actually do is not dissimilar to buy now, pay later, but it focuses on much longer duration and higher value loan products. In other words, we understand, and this is not new to the market, it's always been a challenge that many look to solve in many different ways, and we'll speak about maybe the unique solution that we bring to the table. But when a consumer or a small business has to make a meaningful transaction, and this is both for goods, you could be renovating your office or renovating your home, You may be buying a large electrical appliance, but it also may be in the world of services. You may have to undergo a medical procedure that is expensive. And this could be a critical medical procedure or an elective medical procedure where you want to go for teeth straightening or hair implants. I'm sorry, I go to the same barber as you do, Darren. So I can say anything I want. In any case, all of these types of activities require finance, require financial planning. That's on the one side. That's in terms of the consumer's need. In terms of the merchant, as you said, rightfully so, the merchant is looking to sell. And if they can present options that help and support their customers in making a decision and ultimately following up with a transaction, they want to bring that into the experience so that they don't lose the momentum and don't lose those customers. From the bank's perspective, and this is also where we're, I think, a little bit different to the other players. Jifiti does not lend. We do not take balance sheet risk. We are a pure technology play that enables the three parties: financial, retail, merchant, service provider, and user, consumer, small business to transact. That triangle has to transact in real time. And we allow for that through the technology that we provide. We allow for that entire process to take place in real time. If we go back to the bank that is serving as the lender here, as the balance sheet lender, their mandate is to distribute the funds they have on the balance sheet in the form of loans, let's say consumer loans, and do that in a responsible manner where they're managing their risk, where they potentially, after they approve a loan for a customer, may also be able to upsell or cross-sell the customer on a checking account, on a deposit account, and create a relationship with the bank. But the bank is interested in those, what we call in professional lingo, loan originations. They're looking for as many quality loan originations. And if you think about the merchant making their offering available at, for example, a point of sale, that means in store, online, wherever it is, they're benefiting from the fact that this brand or merchant or service provider has a customer base. And their customers are coming to them and being introduced to the bank's offering when and where they need it most. That's our mission statement.
So where you're playing, please correct me if I'm wrong, Yaacov, but where you're playing here and where the opportunity that you're trying to unlock, and clearly very successfully, is working with perhaps some of the more incumbent or traditional financial services players that want to digitize, that want to offer these types of products and services, but perhaps don't have the technology or the time or the expertise to be able to build a BNPL offering and then go to take that to market. So if I'm hearing you correctly, you come in and say, Mr. or Mrs. Bank, we'll provide you the technology. You provide us you provide the balance sheet, whether it be white labeled or not. I guess that's probably a separate conversation. And then consumer and merchant in this case can just play immediately. Have I understood that correctly?
Absolutely, that is purely what we do. And there's a reason behind this. And there's a reason that we also chose to cater to these incumbents, or some like to call them dinosaurs, unfavorably. But of course. But on a more fundamental level, when you really map these players out, we believe that each one of these players has an expertise, and they should stick to their expertise and leverage their expertise. There's no reason in the world that they should spend more than 50% of their time on an area that is not their cup of tea. So, for example, when we look at the merchants know how to push product. They know how to market their products. They know how to sell their products. They're looking to sell more product. There's no reason for the merchant itself, or himself, herself, or them, to decide that all of a sudden they're going into the finance business and take a risk on the sale in addition to all the other activities they have to do in retail in order to move product properly. On the other side of the spectrum, you have the bank. The bank has, especially the incumbent banks, have decades, sometimes even centuries of experience in managing their risk, in underwriting customers, and they know how to do that best. Moreover, incumbent banks usually have a lower cost of capital than many other fintech players. Why is that? Because fintech players are raising a balance sheet on the market, and there's a price to pay for that. The incumbent banks are sitting on your and mine deposits, hopefully. And therefore, their cost of capital is more efficient than many of the fintechs out there. And therefore, they're able often to provide better pricing to the end customer. Another very interesting characteristic of these established financial institutions and banks is that they're more often than not heavily
Yeah.
regulated. And when they're heavily regulated, we also can ensure that their practices are ethical, that the consumer is protected according to each market's consumer protection laws. And that's very important to us, especially when we're speaking about meaningful transactions, because I think you and I both know that consumers who are not necessarily educated in the world of finance can sometimes find themselves in deep debt or over their head in debt,
Absolutely.
not necessarily for a good enough reason. And therefore, the fact that these banks and lenders who we work with are heavily regulated and their practices have been scrutinized and comply with the ethics and the law in the local market gives us the confidence that the customer ultimately, when they are contemplating a larger transaction and need to finance that, are getting better pricing, are partnering or receiving those funds from an institution that is regulated and will protect them against unethical behavior.
So, sweeping broad statement here. Bear with me, right? But are you guys effectively democratizing fintech? And are you guys now, have we come full circle where actually fintech's being disrupted by fintech?
That is a great question, and we do see it as a pendulum that in many areas, right, where you have an entire industry that is disrupted by fintech. And in this case, in this context, I can name many of them, both on the northern hemisphere and the southern hemisphere, that many of your viewers and listeners may be familiar with. Starting from Klarna, Affirm, Zip, Afterpay, and so on and so forth. These were players who basically said, we can do the job of both the bank and the tech. And essentially, very, very quickly, especially for online, in-store was a completely different story. We may have time to get into that, and we'll speak about that as well. But we can very easily make a pay in 3, pay in 4 possible. And we will take the risk. We will underwrite this loan. We will also raise the balance sheet. And what they did prove to the world, and this was an amazing achievement of theirs, and I take my hat off to them, is they showed that this type of product, if it's configured properly in terms of the tech, is seamless and is scalable. Something that traditional banks and financial institutions had a very hard time doing. If you think about your bank, whichever bank you bank with, it's tough enough for them to make their experiences within the 4 walls of the bank, physical or digital, seamless. Can you imagine what a challenge they had when they tried to bring their offering into a foreign environment, like a website that is hosted on Shopify or a shopping experience in an IKEA? These things were very challenging for them. And what the fintechs have done is they've shown that, at least online, if they build the right type of tech and plumbing and rails, they can scale their business. However, and this obviously proved both to the market as a whole and to the banks and financial institutions that this is a real large market to be had, and they can really take market share. However, they are limited. They have the limitations that we mentioned before. They are not necessarily a full-fledged regulated entity that can go into regulated loans. They don't necessarily always have the type of capital that these banks do, and they don't always necessarily have the same type of underwriting power, even though we see disruptions in that world as well. And what has happened after they disrupted the market was we came in as enablers and supporters of the traditional banks and financial institutions and said to them, guys, it's your time to come back in and disrupt it once again using our tech and your firepower of underwriting and balance sheet. And that's the phase that we're in.
It's super interesting. The conversations I've had over the last decade, probably, with fintechs and banks, and we talk about fintegration and fintechs working with banks and banks working with fintechs and what have you. And quite frankly, I'm bored of those conversations because that's all they are. They're conversations. But when we look at this type of model, and you look at where banks talk a lot about transformation, digital transformation, and in the public domain, what does that mean? That means, okay, I can now access my bank account on my phone, right? Very, very rudimentary. That's what I can do, and I can, make payments, and I can get a loan or whatever it may be using my phone. But actually, when we're talking about digital transformation for a banking institution, whether it be a bank that's been around for 200 years or it's been around for 50 years, it doesn't really make a difference. Is actually a change in the operating model of a bank. Okay, so traditionally a bank will earn, again, I'm not a banker here, but from a consumer would earn on a bond or a mortgage, would earn on credit cards, would earn on home loans and what have you, right? That's their kind of primary source of income. But what they don't typically offer is that point of sale, which we're coming on to now, that point of sale offering to say, actually, I'm going to use my bank, whether it be ABSA or whether it be JP Morgan or whether it be HSBC, and I can actually make that payment now. I can choose to do buy now, pay later. I don't have to go through any KYC because the bank already knows me. It's seamless. I've got trust as a consumer because I trust my bank. Okay, whole nother conversation, not one for today. I think it adds to that full sort of flywheel that the banks are trying to kind of get onto now, going, how do we retain our consumers or our customers? Because what we're seeing is, a large number of fintechs coming in and disrupting. And yeah, okay, from a lending and from a micro lending perspective, it may not affect their, their P&L or their balance sheet, much at all. But I suppose if you look at it over the next, decade, actually that's probably going to have quite an impact. So how does a bank use technology, use the learnings that they've had from fintechs who have been there and experimented, and many have failed and many have succeeded? How do they take that knowledge and not have to then go and completely reinvent the wheel, but use what the bank is great at, which is, as you quite rightly said, the infrastructure, the compliance, the regulatory side, the trust. How do you take those elements and actually deliver that to a consumer? And so this is fascinating, really fascinating. I do want to talk about the sort of card present or the in person in a retail environment, how that works. You mentioned it a couple of times. Can you just elaborate?
Sure. First of all, by the way, I think you did an incredible job at really honing in on. I think it's almost a revolution, or at least an evolution or the evolutionary phase that we're currently in. And I'll just maybe add to that, and then immediately tackle the in-store type of experience and model. But even if I think about the last 5 years, and we really started doing this a little bit over 5 years ago, we started selling directly into banks and financial institutions. And I think about our early conversations, and for the first year or two, we were hearing the same thing that I assume many tech companies who are selling into financial institutions here, and that is the deliberation of the bank between buy, build, or partner, right? And like you said, you've had numerous conversations about this. And what we found a few things. Number one, we found that over the last 2 years, we're hearing a lot less of build. The pace and speed at which this ever-changing ecosystem is running at is one that at least those smart people at the bank understand that they'll just be pouring in good money after bad, and they'll never reach the curve. But there's even a more foundational point, at least in the areas that we are engaged in, and that is that in our areas, there's a pretty clear line between the activities that take place outside of the bank and inside the bank. Meaning we are no longer speaking about just selling them a service that they're going to implement and run for their own banking activities as they do today. We're taking them outside of their comfort zone, so to speak, into brand new environments of online, in-store, retail, service, et cetera, et cetera. Now, yes, obviously they can hire another 300 programmers and decide that all of a sudden they're going to become experts at embedding into this terminal and that POS and make sure that it's compatible with this type of shopping cart, et cetera, et cetera. But it really is outside of their expertise. And therefore, I think they also feel a little bit less threatened. And when they're a little bit less threatened by that, and you create a very clear division, we are not looking to replace you as an underwriter. You do that. We're not going to even market to you new underwriting technology. Use what you have, or use the other financial services companies who you've been working with for decades, who, by the way, we partner with very naturally, because what we're doing is build around those core banking components. So we've really found, I think, a good way, or a good vertical or sub-industry to partner with banks with, and prove that fintechs and banks, as long as they know what their expertise is, can really work well together. But now, let's make a very, very quick kind of change into the in-store shopping experience. So if you think about an online shopping experience vis-a-vis an in-store shopping experience, and it's actually interesting, I spent quite a bit of time yesterday on a webinar really going through the motions of a shopper who walks into a large department store or furniture store, and what that experience looks like from a financial standpoint, when psychologically you're contemplating more or less when you meet an offering, how you access the offering. But even before we go there, an online shopping experience that is presented through a website or mobile device or whatever it is, by definition has a certain level of engagement that can be turned into an interactive engagement throughout. That means we all know that when we're shopping on a website and they're collecting the data in real time, they can decide to push an offer. They can decide to remind me that I may be also interested in this and I left something in my cart. And therefore, there are many options of presenting discovery, we call it, of, for example, a financial offering. So on an online shopping experience, it's very important for us to embed the offer of finance early on, so that they know that they may be able to buy more. They may be able to go for the more premium version, because they don't need necessarily to have all the cash on hand. There are options for finance. How do you do that in a physical setting where the engagement is maybe the wall, where you can put a sign up and you hope they look up to it and understand what you're writing? But really, in the world of point of sale finance, which, by the way, has been around long before. I mean, in certain countries, it was prevalent, in others less so. But if you take the United States, for example, where in general, the credit environment is usually one that is robust, meaning that's a nice way of saying that Americans are highly leveraged and max out on their credit card lines often. But in any case, this notion of offering finance at point of sale in stores, especially stores where it is a higher average ticket value, was prevalent, but the experience was horrible, because one would have to go through the entire shopping experience, hopefully seeing a sign that says at the very end, you can apply for finance, which basically means you have no idea what you will qualify for or won't qualify for. And second of all, once you reach that stage, you have to ask to apply for finance. You often have to give over your details to a stranger, a coworker that you just met about 5 seconds ago, your annual income, and your wife's favorite drink. Not quite, but almost. And you then don't even know if you will be approved or declined. So you may have to leave the cart with all of those very valuable items on the side and take the walk of shame while everybody in the queue is watching you. Terrible experience. And even if you, for some reason, are brave enough to go through it, this means that the original setup was such that they had to go through all these integrations with a third-party financial institution that integrated somehow into their systems, where they can make this offering, train their personnel, and the happy flow, 1 out of 6, will be able to go through this entire shopping experience. We decided on day one, when we got into this business of embedded lending, we decided that we are going to tackle in-store equally with online. And as I mentioned before, many of the other players weren't doing that. The in-store was very, very scary. There are a trillion different systems in retail that you have to integrate with, and they're not fun. A POS, a terminal, a reconciliation, an acquirer, a gateway, not very fun. Online is a bit simpler. And we said, no, we have to turn this on its head. And with the risk of boring everyone, I'm going to take 30 more seconds and just explain what we did, at least in some of the cases where we felt that this was proper. We said, we have to reverse the entire experience. Number one, the customer or consumer should be able to control this entire experience on their own mobile device. They should be able to discover it immediately when they walk into the store or before they walk into the store. And they should be able to complete the application process and receive a real-time credit approval before they go on the shopping experience rather than after, so that they know exactly what they can afford and what they can't. And in order to do that, it was simple math and simple technology. Scan a QR code, fill out the application form on your own mobile device, privacy, discretion, no need to shy away from applying because you have the fear of decline or fear of rejection, and know your purchase power ahead of time. And then we layered into that another piece, which is what you referred to in terms of the card. And we said, but once you're approved in real time, before you even take your shopping experience or while you're just walking down the first aisle, why don't we send to you a virtual card? This was early in the days before wallets became prevalent, that will carry the funds that you were approved for. So that when you check out, ultimately, nobody knows. Nobody knows means it's seamless. Nobody knows means you don't have to stand at the top of the queue and apply for 15 minutes while everybody's yelling at you behind. Nobody knows means you don't have to train the in-store employees that there's some kind of new financial activity going on here. You have a virtual card. The only issue we had back then was that a virtual card was not always easily processed at the point of sale. They had to key it in, and in order to do that, but once wallets became available, we were the first, I think, to provision this type of one-use card to the wallet and allow you to tap out. And that was the silver bullet. Now, we've been able over time to use that mechanism not only for a one-time card. You can underwrite anything you want. If the right type of product is a revolving line of credit, so be it. If the right type of product is the installment loan, so be it. If it's a split pay in 3, pay in 4, that's fine as well. And what we were able to do was be able to build quite a robust enablement platform that allowed to match the right type of loan program to the right type of environment, the right type of transaction, and do this whole thing at the very beginning with discretion, without any dependencies on integration, without any training of personnel, and create a seamless checkout at the very end. That's the new in-store embedded lending experience.
It's fascinating. I've questions. I could stay on here for 2 hours with you, honestly, Yaacov. But let me just try and sort of condense these a little bit. So let's take a shot. I won't mention any names. It doesn't actually. We can. Let's take Macy's in New York, right? It makes a difference. Okay. I walk in there as a consumer, and I bank with JP Morgan. Macy's would need to have acceptance of JP Morgan plus every other bank in order to be truly inclusive. Is that correct, or have I missed something here? Is it actually Macy's that would own that sort of infrastructure? You know, I come in, I scan my code, and it takes me to the Macy's app, for example, and within that app, it then sort of prompts me to say, you know, who do you bank with, and I go JP Morgan, and then it instantly does KYC and instantly gives me sort of my credit line or my availability of funds. Or is it a case of actually Macy's are kind of the front end, and actually whatever powers them at the back end, whether it be JP Morgan or HSBC or Chase or whoever it may be, that's actually the back. I'm just trying to get my head around the flow from the consumer.
No, these are excellent questions. So I'll tell you first of all what we see, and then we'll speak a little bit about what can be in terms of other types of structures or other types of models. In the vast majority of the cases that we are involved in, we're speaking about a bank, usually one primary bank that has partnered with the brand, and the undertaking there is to be able to underwrite any applicant, regardless of where that applicant currently banks. So, for example, if you bank with a Wells Fargo, but the deal that Macy's have is with Chase, Chase needs to be able to underwrite you. Now, in some countries, that is regular practice. And the reason that that's regular practice is twofold. Number one is because it's possible to do where you have an organized credit bureau and really what you're looking up in real time is a FICO score. So even Chase, who don't know Darren at all, once they receive those 6, 7, 8 fields of information, they run their credit checks that include FICO. They're not exclusively FICO, but they include FICO. And there's a whole industry there of decisioning and underwriting and so on and so forth. So that's the first reason, because it's possible. And therefore, those are the structures that we normally see. The other reason is because, as I mentioned before, in this case, Chase sees that engagement with Darren as an opportunity to bring a new to bank customer. So I've met you at Macy's. I've provided you with your finance when you needed it most. And now I built some kind of relationship that I can leverage.
Very clever. Very clever. Okay, I get it now. Okay, so the merchant effectively, depending on the banking partnership they have, their primary bank or whatever, that's who effectively is the sponsor and the financier behind the BNPL solution that, in this instance, Macy's would offer. Yeah? Okay.
Correct.
And then
Correct.
it's white labeled as Macy's BNPL or not? I mean, does that kind of area?
So there are different versions. In most cases, what we do is there's a certain co-branding, meaning this is Macy's powered
Yeah.
by. I will just make a small tweak. We find that in this industry, there are banks and lenders and financial institutions who really specialize in this type of embedded lending or point of sale lending. And therefore, it could very well be that a brand or corporate has one bank for their treasury and ongoing internal activities, and another partner that is solely tasked with offering customers or consumers the type of financial instruments that are needed.
That makes total sense. Okay, my last question, because we're running out of time. I'm going to ask you to get your crystal ball out. Okay, 5 years from now, where are we at? What does the landscape look like in terms of embedded lending?
100%. So first of all, our checkout is going to continue evolving. If once upon a time, until not long ago, you expected to see, like I said, MasterCard, Visa, American Express as the options, with time, PayPal in some countries became very popular. In Africa, obviously, other providers. What we're going to see is further more an evolution of all sorts of other products on that checkout page being offered. We're going to see more and more of that where the transaction, the higher average ticket type of transactions and phases. But I think what's even more interesting is we're going to start seeing these things embedded in places that right now sound very foreign to us. So, for example, if you think about the world of B2B, where does a small business owner transact? So sometimes they go to the same outlet. They'll go to a Macy's, they'll go to an IKEA, et cetera, et cetera. But in certain industries, there are ordering systems, procurement systems, other ERPs. And what happens when you all of a sudden embed financing into an ERP system where you're able to plan your inventory, or you're able to make a smarter purchase without having the cash on hand because you figured out that from a cash flow perspective, that makes sense. And I'll give you one last example of where we're going to see a lot of development, and that's in the whole world of accounting software. So think about receiving an invoice and being able to deal with it from a responsible financial planning perspective and having the tools right there. We're going to see more and more of that. And I believe that what we're also going to see is some of the more what we consider today traditional banks taking back large market share and finding new channels for origination.
I think the trade finance thing, which I think kind of you were alluding to there, I look at it as an SME to think, okay, if I'm in zero, my accounting software, and I go and raise an invoice for $10,000, and I know that client is going to take 90 days or 100 days to pay. If I can suddenly click a button that says, would you like to withdraw, 80% or 70% of that now? Yes, there's a fee. Of course, there's a fee. It's finance. But that's fine. But if I can do that instantly, I know that those funds are going to reflect sort of pretty much straight away. We've got rapid payments, we've got instant payments straight away into my bank account. Hey, I'm going to be smiling, because one of the biggest challenges that SMEs face globally is collections.
100%. We are now involved in a massive project that is precisely what you're describing, with a bunch of different creditor let's call it
Yep.
entities. And we're speaking about stage one of volumes in the billions. That seamlessness changes behaviors and alleviates many of the pressures, especially for small business owners.
Absolutely. Fascinating. I think you guys are definitely on something. Well, you don't need my tick in the box to say that. Clearly, you guys have been around and know what you're doing. Listen, it's fantastic to talk to you, Yaacov. If people want to find out more, I know we have a number of bankers that listen to this podcast. They may not tell their bosses, but they do. Where do they come and find you?
Sure. So I have to say, we do have a pretty phenomenal marketing team, and I can say that because I take no credit for it. So find us at jifiti.com. Write us an email to anywhere at Jifiti, hello at Jifiti or team at Jifiti, however you feel comfortable. It'll get somewhere and it'll be attended to. We have loads of materials for education. If we're the right partner, that's wonderful. If not, we'll just be happy to share some of the knowledge and expertise that we've gathered
Amazing.
over time.
Well, we'll put some links at the bottom here, anyone, but perhaps to Yaakov's LinkedIn profile, but also to the business as well. So direct any inquiries there, or feel free to drop me a line, and happy to make an intro. But Yaacov, listen, thanks so much. I've thoroughly enjoyed this. I've learned a great deal, and I've even got a kind of a title in mind for this podcast, but I'm not going to spoil it now. So you'll have to just wait and see. Thank you again. Have a great sort of end of the week and weekend, and we'll speak again soon.
Wonderful. Thank you for having me.